the situation is still quite volatile. So we are urging our clients to act with caution, but at the same time being proactive in keeping up with the pace of changes and also preparing themselves. So what we are seeing currently in the market, especially major multinational and regional groups with exposure to the US, is they are gathering their trade data. They are running their trade data with leveraging technology and making sure they understand the financial impact of the potential tariffs, whether they stand at 10% as they currently stand, or running different scenarios, right? So I think once you understand your potential exposure, what we are seeing companies do is preparing a mitigation plan that, given the situation is still quite volatile, would include short and medium and long-term measures, right? So if you look at the US customs legislation, there are still some reliefs and exemptions that can be utilized. Look at, for example, the use of free trade zones, duty drawback, which is a customs duty refund system for re-exports in the US. So that's a major thing to look at. And you can also look into lowering the values of your products to the US by leveraging transfer pricing, quick wins methodologies, and also looking at HS classification, and more importantly, to try to benefit from the list of exclusions of goods. I think a lot of people is forgetting that, the executive order that was issued on the 2nd of April by President Trump has a very long list of excluded goods, including energy goods, sensitive and rare minerals, chemicals, polymers, and a lot of components that are manufactured in the Middle East and exported to the US. Those, as we stand, are exempted, right? So there's a quick exercise is looking at that exemption list and see whether you can fall under those premises, right? Then more medium to long-term strategies obviously would include revisiting your global tax strategy to optimize cost, and also more in the long term. And again, because the situation is very volatile, we are not seeing companies as to actioning that now, but obviously considering changing sourcing strategies, manufacturing locations to try to comply with the rules of origin and get to the US on the lower end of the tariff. So those are some of the measures we are looking at, and obviously, people looking at contractual agreements, who pays what in the supply chain, and trying to sort of as well scratch some money from those elements to make those quick wins, more realizable. So that's in a nutshell what we are seeing there.
Indeed, and it's been so interesting to watch as well, just given all of the headlines around the tariff space right now. Carlos, let's double click on the strategy that we're seeing out of the White House as well. A lot of criticism being leveled towards the Trump administration on not just the back of the napkin mathematics here, but also the messaging around these tariffs. Of course, politics is about creating a problem that policy can solve. Trump has effectively done this in the past, but the messaging on tariffs has really been impacting the market, as we have seen over the last couple of weeks. The latest, of course, being the exemptions on mobile phones, on some chip supply chains, on computers as well, these electronics and consumer goods. What's behind the tactical carve-out of this sector, and is this designed to serve the interests of the United States, or are there other factors at play?
Well, I think, as we've seen in the last couple of months, there are a number of decisions being taken by the U.S. administration. Some of those have been reversed or have been paused, like the last time, 90 days, I think, to capture some of the negotiations that the trade partners might be trying to undertake with the U.S. administration. But I think from a Middle East perspective, and I think more specifically from a Gulf region perspective, there's also an opportunity to leverage this, major volatility in the global trade system, and capitalize on the investments that the Gulf countries have been making in the past few years to diversify from the oil economy, investing in infrastructure, industrial cities and special economic zones in Saudi, for instance. The UAE has continued to become very bullish about their international trade agenda, conducting a lot of free trade agreements with different partners. Only last week, it was announced that they were starting talks of a free trade agreement with the EU. So I think being in the Middle East and more in particular in the Gulf countries, I think there's an opportunity to, one, strengthen regional cooperation. I think we have two major economic blocs in the Middle East, the GCC, Customs Union or Economic Agreement, and the Arab League. Those regimes, in my personal view, after having worked in the Middle East for quite some time now, require some additional integration to basically promote inter-regional trade. That's one important thing to consider. And also looking at other countries, like, for example, Oman, investing as well in diversifying the role of their free zones and making sure that all these investments in the last few years capitalize now. We've seen some influx of multinational companies requesting and showing interest on having the Gulf as an alternative trade hub or manufacturing hub, given what's happening in the region and given that other traditional alternative options are in the list that the US administration published beyond 10%. So I think the Gulf is well positioned to leverage that and capitalize on those investments I was mentioning before.